I mean, that right there it's an insane deal. It's going to set you up for long-term success. While there's some deferred maintenance, it's not.
Guys, welcome to the Big Picture Blueprint. Today we're coming at you with a solo show. Well, not solo in the sense that it's Mason and I. We don't have a guest. We're going to be talking a lot about what we're doing right now, projects we're doing, what we're seeing, where we expect different markets to go, all that sort of thing. But before getting into it, Mason, how's it going?
It's going well. It's an exciting time for both of us in business. I think it's always a constant reminder of whether you view us as experts or not. We still feel like we're new in the business. We've both been only doing this for a few years. So we've spoken in other episodes about setting up our business for long-term growth and setting our assets up and strategy up to make sure that we're doing all these things that we're going to be really, really happy about in 10 to 20 years. And I think as our businesses evolve, we've really started to hone in on the best strategies that make sense, both for personal net worth building as well as just the operations of business within the world of real estate investing. So it'll be a fun show.
Yeah, agreed. And what you said there is funny because I heard Alex Hormozy talking about this on a recent podcast where he's worth, I think, over $100 million. He's like, I still feel like a beginner because if you're progressing, you're always working on something new and then are uncomfortable. And I'm very uncomfortable right now. It's been a great year, making a good amount of money. Rentals are performing, things are great, but I'm buying a bunch more. I'm building some. There's so much going on. There's just huge amounts of cash going in every direction. I'm very uncomfortable, as I am sure you can relate to.
Oh, absolutely. And it's so funny too, where we both will feel ourselves making these decisions over and over again that we're like, I'm not going to do that again. That just put me in a position that made me really, really stressful and really uncomfortable. I had a deal recently where I've said it before, and we talk about it on the episode or podcast that, I've been interviewed on as well, where I really try not to put my own money into deals anymore. I always have some skin in the game to a certain extent, but sometimes a good deal comes up and I'm like, oh, perfect. I'm just going to fund it myself. And then it happens 20 more times. And then I feel like I'm out of cash again. And I'm like, Mason, just listen to yourself for once in your life. So listen to what we say. And we give really good advice, even though we don't always take it ourselves, even though we try to. So yeah, Dan, I think we should get right into it. And you can go first with one or some of the projects you've got going on right now.
Yeah. So I have to comment on what you just said. Absolutely. But number one, it speaks to the reality of theory versus reality. I didn't mean to use the word up front there, but we all want to see things work out a specific way. And all right, I'm never going to use my own cash in the business. It's just, it never works out exactly like you want to. And these things are going to happen. And yes, I personally keep a lot more reserves than I used to. I think you've done a good job of that overall too. But the way you plan it is never how it's going to go. Just FYI, one other thing I heard Hormozy say on a podcast is, I'll censor this, but business is just getting kicked in the teeth nonstop all the time with occasional glimmers of hope. And it's so true. And the second point I wanted to make too is when I think about when I started, I'm long past accomplishing what I set out to accomplish. But once you do that, you realize, I don't want to just sit around and go snowboarding all day. That would be boring. And so for those that are listening that are a little newer, that have this shining goal that you want to reach, I promise when you get there, you're going to have bigger goals and other things to work on, which at this point, I can sit here and say, that's fine. It's fun. I don't think of some end goal as being all that I'm working towards. I'm just having fun, continually getting better and building. Anything you want to say to that, or should I get right into this, Mason?
No, you're right. I think the goalposts are always moving. You keep feeling like you're getting closer and closer to realizing whatever arbitrary goal it was, of whether it's net worth or cash flow or time committed to the business or anything like that. And then you recognize, depending on your personality and everything, of, okay, I've hit that point. I can stop now. And I can go snowboarding every day if I want to, and I never have to worry about business or the stress of it over again. But it feels masochistic sometimes. It's really kind of fun to get yourself into those positions because then you have to work yourself out. So I think being in our 20s, obviously our risk profile is a lot different than it'll be in our 40s or 50s. And I look forward to the growth and evolution. But in the meantime, setting ourselves up so we're allowed in our 50s to go snowboarding every day if that's what we want to do. So
I thought you were 30 now.
almost.
I know. I'm
almost 6 more months, and then it's all downhill from here.
I know when your birthday is. I was just messing with you. But okay, all right, getting into it. One of the big things that I'm doing right now, so I bought a fourplex, and full disclosure, I'm 50-50 partners with a friend, an investor friend of mine on both of these. So bought a fourplex that I'd been working with the seller for 2 years, and actually on our trip back from Japan, Lisa and I had a bunch of friends went to Japan, I get a text from the realtor she had kind of do the transaction coordination on the last one, say, hey, she wants to sell the other one. And I'll tell the story because it's kind of fun. She tried to play tough guy with me. They go, oh, well, yeah, we're going to list it at $650. So let me know if you're interested in just making an offer. I go, no, thanks. Just left it at that. Bought the last one at $575. And then a few days later, I hear again, well, she's got a building she really wants to buy in Ohio. So would you do 600? She's kind of motivated, which a good realtor would never tell the opposing side of the negotiating table that the seller's motivated, but whatever. And I go, no, I would buy it at the same at $575, same terms. And so anyways, long story short, buying another fourplex, they're side by side, completely identical. And what I like about the second one, the first one had a bunch of long-term tenants, rents were a bit low. And so it's going to take a long time to get the rents up. Because if you have a good tenant, I really don't like just upping the rents and kicking them out. I don't do that. So left rents where they were, like 3% increases on 2 renewals on the first one. The second one has 2, potentially 3 vacancies. So we can turn those units, get those up to market, and push these towards market. Because the 8 units collectively were far, far under rented. If this was done properly, should be $14 to $14.50, depending on how nice we make the units. And they were all at $1,100 to $1,200. And they're not well managed. I mean, my gosh, if I was slimy, I could send threatening letters to the seller, pretending to be a tenant to get some of our other buildings, because my goodness, they're so illegal. It's so bad. All these units, smoke detectors missing, carbon monoxide missing, things. It's bad, and I'm surprised the tenants have been so good given how poorly she's taking care of them. So all that to say, it presents enormous upside on these 8 units, because once we get them up to market or even close to market rents, they'll hit the 1% rule. There's a decent amount of equity in all of them, great as far as depreciation. And I'll pause, but there's some overarching concepts I want to pull out of this, but supply and demand are one of them in this market is in short supply.
Oh, for sure. Well, and let's napkin math it, Dan, because these 8 units, it's essentially one deal because it's so close. You had just purchased the other one right before. How much did you buy them for, and how much work are you going to have to put into them total? And how much equity or are you getting through any improvements that you're doing, as well as bringing them up to market rent? And how much is this really impacting your net worth? You don't have to go into the actual numbers or, super detailed numbers, but just looking at it at a high level, it seems like very, very, very good for your net worth building.
Yeah. So we're buying both, or bought the first, buying the second, closing a week or two, both at $575. And what those would sell for on market right now is challenging because there are no recent comps. I mean, at the height of the frenzy, $675, $700. But today, I would bet a decent chunk of change that they would sell $640, $650. I mean, so there's these 2 buildings that we're buying, and then there's 3 more that are identical that another person owns. He listed those last year, late last year, like $695 for a while. And I think the highest, just as it's a small market, I know what was going on. The highest offer he ever got was $675. So I would be pretty confident they'd both sell at $650. So call it $75K equity in both of them, so $150 total. And
that's just from you purchasing them at a discount because you had a prior relationship and long-term follow-up, and you know these people and that sort of thing.
Yep, 2 years of follow-up, guys. So then, as far as rents, I'm pulling from everywhere. I don't really know what the mortgage is. It's $3,000 and something. I think upper 3,000s. And then we pay 10% in property management. It doesn't cash flow much right now, but I I don't really care. I think about the amortization, the depreciation, and the equity I bought into. And so let's say we get the rents up slowly to even $1,400 a piece. That puts us at $5,600 in rents. There'll be about $1,000-ish cash flow, maybe even a little more if we can get it closer to the $1,500 mark per door, because utilities are paid entirely by the tenants. It's all billed back, the stuff that isn't separately metered, and then it's just budgeting for CapEx and repairs. But these are such simple buildings. They're built in 96, same age as me, just simple squares, simple infrastructure, and they're in pretty darn good condition in a nice area. So I'm not a huge amount of CapEx is coming up. Parking lot was recently redone, thankfully. So, that's approximate numbers.
Yeah, well, and I mean, looking at it you added $150,000 to your net worth just by doing long-term follow-up, which is insane. A lot of people don't even have $100,000 net worth. And gross revenue, you're going to be making right around $134,000 a month on both of these buildings. And if you subtract all the operating expense and everything like that, which probably isn't that much, you're adding, before debt service, another $100,000 a month in net operating income to your total portfolio, which if you wouldn't traded that, I mean, that's huge. My guess is you added, once these are stabilized in a year or two, you could sell them and get $500,000 out of them.
$100,000
back into your $100,000 a year.
Yep.
I might have misspoke.
Okay, there we go.
I'm not that bad at math.
Yeah.
I'm bad at speaking, but not bad at math. But I mean, that right there is it's an insane deal. It's going to set you up for long-term success. While there's some deferred maintenance, it's not astronomical, gigantic, huge issues at the core of the foundation of the property that you would expect, $100,000 in repairs per unit type of thing.
Yeah, absolutely. And there's a lot of points I want to make from this building, but there's another project where I can make most of them. But just to your point, and then we can transition. This is why I'm so set on only buying newer real estate, right? I say younger than me, and where I can place tenants with 700 or better credit scores. Because, I mean, having done this for 6 years for myself, and then having managed, over 6 years now, other people's rental properties as a kid, as a teenager, it's just such pain to buy C real estate or old real estate in crappy areas. Whereas nice, newer real estate that gets great tenants, it actually can be passive. Like a number of the houses and buildings they are passive. I don't hear anything. I've owned them for a long time, and they're kept immaculate. And so a lot of that comes from nice buildings, newer, in nice areas. One other thing, only half of that's mine, remember. So half of that net worth is to me and the other half to my partner. So I'll pause and transfer or pass the mic to Mason to talk about one of his projects.
Yeah, I think it's a constant reminder of, just because we're talking about this doesn't mean we don't have other partners in these deals and everything like that. And if you have the time or you have the money, there's opportunities to work with either us or work with tons of people in the space that are great at finding deals. So great opportunities. This seems like an amazing project and something that I'm highly envious of, because with me as someone that doesn't own, I own something that will eventually become a rental one of these years. It's very much so changed the strategy that I want to invest in moving forward, where I've learned so much, and it's going to be a great, great long-term project. And if you guys follow us, you know that I talk about this project all the time, which is this commercial building in downtown Pagosa Springs, Colorado, that purchased in August of 2022, and it's still getting renovated. We actually finally got the new numbers from the new contractor 2 days ago. We're recording this May 6, 2024. Received the final numbers from the contractor May 4th, 2024. So this building, long-term, I'm very happy with it. It's in a perfect location. It's walking distance from all of the amenities in Pagosa Springs, Colorado, which is a ski town. It's got the world's deepest hot springs. I love it. My family lives just south of there. And I think that I see where it's going. I don't think it will ever completely turn into a Breckenridge or an Aspen. It just doesn't have as easy of access to the rest of the world. It's kind of in the middle of nowhere, but people that know Wolf Creek Ski Resort know Pagosa Springs. I have tons of random people I talk to that know the city, know the town, and have a ton of desire to go there. And owning a piece of land in a downtown on a main street is typically always worth it if it's the right main street, not necessarily Walsenburg, Colorado, or some of those really, really small towns that you feel like when you go in, they're falling apart. But I bought this deal. One, it was a pocket listing that my realtor brought to me. I am 50-50 partners with someone on it as well, so I had, to bring half the money to the table. But we purchased it for $450,000, which was definitely a discount at the time to what it probably would have been worth if it wasn't a relationship deal. 20% down, 5% interest over 30 years, which is really favorable financing. It's seller financing. There's a balloon coming up in about 3.5 years on that now. But my issue with this is, unlike Dan, I bought a building that is 22 years older than I am. It was built in 1972. 70s was like the worst time for architecture in United States history, so super funky floor plan. People were living in it before, which, I mean, whatever you thought was illegal, Dan, this was like disgusting. I mean, it was horrible in there, and I couldn't believe it. And ethically, I couldn't keep renting it out. So we kicked all the tenants out and started renovations. But to not speak on it too much, we're 2 years in. Hopefully, we'll finish the renovations this summer. All in, our renovation cost is going to be approximately $320,000. And with carrying costs, we've spent about $30,000 on carrying costs so far year to date, or not year to date, since we purchased the project. But with that being said, there's a property that's selling right now, right down the street from ours, half the size, similar unit structure, but literally half the size for almost $1 million. So my realtor down there said, hey, when it's fixed up, we could move it anywhere from $1.3 to $1.6 million if we just wanted to sell it, which has increased, the theoretical equity gains through all the renovations is anywhere from $500,000 to $800,000. So long term, it's going to be a great project. And what I want to kind of pull out of this is, if you're investing in the right area, you're going to be able to, get the gains and get the benefits of what that area has. The first rule, or the first three rules of real estate, are location, location, location. And if you're investing in a very hot touristy area and it's a housing project, which typically there's a shortage on housing, whether it's for vacationers or workforce or just people wanting to live downtown, it shows that there is a mismatch in supply and demand. But I think that in doing it in such a small town, you run into significant issues that, depending on what your business model is or your investing strategy, it's going to make it either a huge pain or an exciting, side project, more, fun project for you if you like renovating stuff yourself, because there are very few contractors. The contractors are very expensive. Most of the contractors have that small town mindset where they're not really interested in working that much. They're more interested in ski season or hiking season or hunting season, which is really difficult to manage if you don't live close by. So I'll pause for a second, let Dan, drill me on some questions about it. But long term, I do think this is going to be a really, really great investment, even though it doesn't feel that way at this moment.
Yeah, so quite a few thoughts, but the biggest thing on my mind is, location kind of trumps all. And so because of where it is, and because it's the irony, right? This is such a pain in the ass to get it rehabbed, but that's also a good thing, because that means it's true for everyone else. And bringing on new supply or rehabbing old supply is very, very hard, which further puts pressure on prices, right? Upward pressure. And so from my position, I'm thinking this has got to be a killer deal. It's just the rehab isn't fun, and you need the liquidity to, get through that. And that takes me to one of my favorite quotes I've ever read, and it's from Howard Marks always says this in his memos: beware the 6-foot man who drowned crossing the river that was 5 foot deep on average, right? And it's the concept of averages can be misleading, where, you look at Mason's project and you think, okay, well, this is going to be worth X, and maybe it's going to cost me X per month to get it rehabbed, except it's going to cost that on average. So, and maybe operating expenses are a better example, but it might be 10X 1 month and then nothing for 9 months. And so you got to have the liquidity to take those, at the ends of the bell curve when that comes up. But anyways, all this to say, I think you're going to make a huge amount of money on this, a giant piece of equity. It's going to cash flow like crazy. It's going to be beautiful when you do a cost segregation. You're going to have no taxes that year. So jealous of that. So can you speak a little bit? I think I heard 450 purchase price, 30 in debt service, like a 200 to 250 more in reno costs. Estimating additional debt service costs, a contingency, everything that'll go wrong. What do you think your total into this is going to be? And then, of course, what the equity will be, and then what will the month-to-month cash flow look like?
Yeah, I think after everything, including renovation costs and then carrying costs, so I only included the interest payments, not actually our paying down of principal in that $30K number. All in will be at 800-ish into the property. And obviously a lot of that will be that is on the actual mortgage and everything. But ARV in between 1.3, 1.5 million. My actual cash into this, will end up probably being 150 to 200K of my own cash. We've done private lending and all sorts of creative stuff, and hopefully we can get that for the last 230K or 225K to finish the renovations, as well as the 130K to pay off, secondary mortgage on it that paid for the initial round of renovations. But all in, 150K, we'll do a refinance at some point to cash the seller's original note out and everything like that, and pay everyone off, pay off the renovations and that sort of thing. And I believe that we'll gross rent probably anywhere from 8 to 12K, depending on the strategy that we implement. So a few grand a month in cash flow, which will be great. But I think what's funny is, like, you look at these deals between Dan and myself, and they're actually really, really similar, which is why I wanted to spend time talking about it after Dan went, because on paper the numbers are almost the same from what they're going to cash flow for the 8 units you got, as well as what this will be after all the refinancing and everything like that. Like, depending on the actual new debt service that we get, it probably won't be the craziest cash flowing thing, even though we added a ton to our net worth and the depreciation bonus is fantastic. But what the difference is, I would rather, at this point moving forward, I'm never going to do a project like this again. I all day will either do simple single tenant triple net leases or nice commercial space, or be a partner on like a deal with Dan, like a quadplex or duplex that Dan's building or something like that, where I don't want to freaking think about it. I don't want to deal with all these contractor relations and everything. And I just don't enjoy that side of the business. And I think that there's a lot of us where you hear all these other podcasts talk about the Burr method, which is what both of these deals technically are. Because yours are seller finance too, right?
No, not those ones.
Okay, those ones aren't. But you've done seller finance deals, and depending on how a seller finance deal is structured, it's not like hard money, but there is a balloon at the end of it. So if you're not adding value and doing some refinance at some point, it just is the exact same deal, which is the sexiest strategy in real estate, and it's a real pain in the butt. And as versus just having a little bit more liquidity and being able to bring more cash to the table, yeah, your debt terms aren't going to be as great, but if the reason that you're investing in these assets is because they're in prime locations and they're not going to take a ton of work and ton of renovations, and yeah, they may cash flow a little bit, but the real reason is net worth and depreciation benefit, then don't cause a headache, because I could have made more money than I'm going to make on this by investing my cash elsewhere in the time period I've been dealing with it. But obviously, long-term, the depreciation and net worth will make it worth it. So it just depends on your strategy, I guess.
Yeah, I mean, that was an excellent transition to the next deal I want to talk about. But before, I mean, you're going to collectively, so half of it's yours, add 500 or 600 conservatively to your net worth. And that's powerful, because if you want, you can leverage that with lines of credit to go buy more deals. In my land business, I have a couple lines of credit. One's leveraged, and the first house I bought in Colorado, I made so much money off that, just using it over and over and over again. Well, that house makes money, depreciated it, right? It's very exponential. And so your deal is better in that sense that you're going to get a larger equity chunk right off the bat, but far more of a pain in the butt, whereas mine are a little more turnkey to do much of anything. So yin and yang. I wish somebody could play that clip of what you just said to me 6 or 7 years ago, because I learned about real estate primarily from Bigger Pockets, where they talk about making investing, using something like the Burr method as your means of making money. I don't like that. Personally, I think that's very poor, maybe with commercial assets because there's such a leverage point being based off net operating income and cap rates. But at this point, I want to focus on just scaling my cash printing machine, aka my active business. And I just want to buy nice, easy real estate or build it, which is the next deal. So anything else you want to say on that before we move on, Mason?
No, and I guess yes, which is this deal. You hear the numbers, and I think, to be honest, myself and my business partner, like, we love it for the very long term. But with the amount of frustrations, there is that emotional decision making that could come in, where if someone came in and said, "Hey, like, I see where you're at with the renovations, I'll offer you market price cash close quick on something like this," I might end up taking a deal like that so I can go put it into similar assets that Dan's in, just because of the frustration with the deal. So even though that's not going to happen, I don't see how that could actually happen in reality. I think it's just making sure that you're making good long-term decisions, that you're allowed to have decision-making that lines up with your long-term philosophy and business philosophy, even if it's not the perfect decision. And it's kind of in line with paying off all your student loans, even though you can make a higher return just putting that money in the market and using the interest payment, which is like the Robert Kiyosaki method for everything. So there is the personal desires that kind of tie into all this. But yeah, Dan, transition, talk about what you're working on, because it's more fun and exciting than what I am right now.
So 989 Harmony, this is a new construction duplex. For anyone that's following me on social, I'm posting pictures and videos of it because it's quite fun. It's always interesting to watch new construction go up. It shows just how simple housing is. Houses are not complex. But I already talked about buying old, nice real estate, new, right? All that. So this thing, assuming we place the tenants correctly, will never, for quite a while, will not need any repairs. The main point of potential risk is if something goes wrong with the contractor, which is why I'm only having this first one done. I have several other lots I want to do the same thing on and keep them, but I'm not doing it till I see this one go from beginning to end successfully. So that's the main risk point. But assuming that's done correctly, and you've heard us talk before about screening contractors, so I'm not going to go into that. It's a 3-bed, 3-bath each side, 1-car garage, brand new construction duplex. It has unbelievable views. This corner lot of the Wet Mountain Range, really, really cool sunsets and sunrises they're going to have from their bedrooms upstairs, surrounded by single family, even though it's all zoned for duplex. That area has all single family, very nice, well kept. Point being, it's going to be a brand new asset in a great area where I can place good tenants and never hear from them again. So there's a couple overarching points I want to hit on here as to why I'm doing this, but more to this deal specifically. I bought the lot for $20,000. I probably have $4,000 to $5,000 into it for soft costs. All right, so plans, engineering, that sort of thing. Very, very cheap, inexpensive in this market. The contractor just built a couple of these. It's a father-daughter team. They're both contractors. They work together, and they built this identical building. Sold them at $586. They appraised at $586. All in, I should be $440-ish. I'm almost assuming that appraisal is going to come down. I was surprised they got such a high one, but let's just say it appraises at $450. Great. Doing math in my head here, I'll have 100-ish in equity. Each side will rent for $2,000. I'll make about $1,000 a month off of it. And the big thing is amortization, the equity chunk that goes to my net worth immediately, a little bit of cash flow, and then the depreciation will be huge. If it appraises at $550, maybe they'll bring back 100% bonus. If not, it'll be 60% because it's 2024, so we're down to 60% this year on a cost sake, which will still be powerful. But big picture, why I'm so aggressively buying these, why I plan to build and keep a couple more of these. You have to make assumptions about the future to some degree, or how do you make decisions on how to act every day, right? So I would be one to say you can't make predictions. People who want to speculate on what's going to happen to the market tomorrow, I think that's stupid. In fact, I would say you are stupid if you do that. But in the big picture, in the long run, over the course of decades, you have to make some sort of assumption, right? And so big picture, when I think about the coming decades and what sort of decisions I want to be making, I've read a lot of books on history of economics, money, that sort of thing. There's one on the history of the U.S. dollar, history on money in general. Hell, The Decline and Fall of Rome has a whole section about this. The Creature from Jekyll Isle is another book on this, but I can go on and on about the history of money and governments and what they do to their currency. But with what is being done to the U.S. dollar and what will continue, there's really no way to go back there. I fully expect assets to continue to inflate within our lifetime. So I am making the assumption that's going to continue until there's a total reset, at which point it would be null anyways. And so I'm buying pretty aggressively. I'll pause here in just a second, but Mason and I just got back from Japan. When I look at the state of real estate there in the big cities, when I look at, we met with some guys from Europe recently, and they were talking about any of the major metros in the UK. Pretty much only the rich own real estate in a lot of these areas. And I fully expect it to continue going that way in the U.S. I mean, if you look at the Los Angeles, look at the coastal cities, which is where everything starts. That's the case. Only the rich own real estate really in New York City and Los Angeles, and it's coming that way in San Diego and everywhere else. And I fully expect that to continue in the desirable metros. So that's my assumption based on all the endless books on history I've read. We'll see if I'm correct. Maybe I'll be totally wrong, but I'll pause there.
No, I think it all makes sense from a huge macroeconomic perspective, and history is always going to repeat itself, and just being able to see the trends. I think the good thing about the United States is we have so much land in the U.S. Potentially a lot of this won't be realized during our lifetime. But with that being said, having a long-term strategy is always going to make it make sense. And I think to just get back into like the more granular part of it, with these buildings that you're buying, with these buildings that you're building, they're all in one market. And with that market, you spoke about the cheap and relatively simple costs associated with permitting and just being able to actually build. And then you've got relationships, you understand it and that sort of thing. But why this market? What are you seeing from, a more macro level of why you're investing here?
I'm so glad you said that, because the point's somewhat null. I kept saying the major metros, and there's an assumption behind that. And this is not a major metro. And what I'm alluding to there is supply being restricted, right? We were just in Tokyo, and every square inch of everything is built out. You cannot add new supply. They've got massive skyscrapers everywhere, right? New York City, Los Angeles, this applies. And so this market in particular is just about out of water taps. They have maybe 200 left or 150. I'm not sure what they're down to. For anyone that doesn't know what that means the lots cannot get water service once those taps are out without a well. And then the restrictions on size of lot for a well is, I don't remember specifically, but it's pretty significant, where a lot of the lots will be totally useless because they're not big enough for a well. And then there's no water taps to connect to the water line. So that's one thing. Now, I expect they'll get...
I'm going to pause you right there quickly, Dan, because we're making assumptions here. Mm-hmm. Obviously, you guys are hearing us making a ton of assumptions. With that being said, with the water tap issue down there, where they're out of water taps essentially, so you're going to hit a threshold where it's like, okay, there is no new building. However, people still like living here, and especially since it's an older demographic to a certain extent, it's actually not as old as you would expect, that enjoy living there and are probably planning on living there for a long time. Are you making any assumptions of, okay, all this land is worthless right now because there are not any more water taps, so I'm going to go out and buy every piece of land that people view as worthless now and hold it for 5 or 10 or 50 years until there's potentially new water taps? Or are you completely avoiding that strategy?
That's not in the collective consciousness yet. A lot of people think it'll be solved. So those discounts aren't readily available. There might be some here or there. But, talking to some of my older friends, I do expect they'll end up buying more water rights. I know they're working on it, but all of this will further push up prices. Water taps have already gone up dramatically since I got there. On this duplex, I think I paid 36 or 40 grand to tap into water and sewer for a 2-unit. That is like double what it was 6 years ago. And having to fork out the money to buy more water taps, I think will further push that up. But the other point I wanted to make, and I don't want to stick on this too long, guys. Read our newsletter. I talk about this sort of market in detail, where it's a tertiary market, and there's a lot of demand, but it's been completely ignored by people. And so you see all these massive buildings going up, apartment buildings in a lot of the Colorado metros, and there's literally nothing being built here yet. Rents have nearly doubled since I've been down there. And so the fact that it's ignored, that there's demand and no one's adding any significant supply, there's restrictions to supply, all this is happening, is a big part of why I like this market, even though it's by no means a major metro, as I was talking about earlier.
No, I think it all makes sense. And I think, the reason I wanted to interrupt and add that is for the right investor and the person that has more money than anyone, that is not looking to do anything with their cash besides diversify and potentially land bank, it might make sense to buy up a bunch of the land at or around market price or slightly below for a very, very long-term vision of assuming that eventually this area will buy more water rights and that sort of thing. But in general, if you can get it and you can guarantee to as much as you can from the local government that you're going to be able to build and add inventory to an inventory restricted market, that there is desire, you're going to have a great asset on your hand for a very, very long time. So I think it works well to pivot to a different type of market where there's not as much inventory restriction, but it's within the path of progress. And I have two markets that I can kind of talk about and two strategies, which is east of Colorado Springs, as well as to the west, and that's west in general, and to the south of Charleston, where both of these markets that's where everything is moving. You look at Charleston or you look at Savannah to the far south, and they're some of the hotter markets in the entire United States. And what happens in these markets, and I'm making assumptions that can be backed by data, is more and more people come in, and there's more and more growth, but you're limited by the ability to bring new supply on the market because it's totally built out, similar to Tokyo, where there's a barrier on one side, which is the Atlantic Ocean, and regardless, new development's going to come in, gentrification's going to come in, all of these apartment units are going to be built, which is something that's happening in Colorado Springs right now as well. We've got upwards of 20,000 apartment units getting either permitted or constructed in Colorado Springs right now. And a lot of the people that were locals or have been here for a potentially long period of time, they're going to start moving to some of these more rural communities that eventually in 5, 10, 50, or 100 years are going to turn into these new big cities, which is why if you can find areas that have inventory restriction, whether it's because of building codes or because of geographical barriers, and you can see where the desire to move is, you have the opportunity to always be creating and adding new inventory to a market where there's a substantial buyer pool. So I think whenever I look at, like a Beaufort County, South Carolina, I'm looking at big plots of land out there because I feel, and just talking with the sellers and talking with the locals, it's kind of an interesting mix where if you talk to them, they're like, the neighbors really, really don't want me to sell. They don't want newcomers coming in. And that's one of those anecdotal kind of weird indications within the market, this narrative indication in the market that says there's something to this, because the neighbors not wanting you to sell means that there are a bunch of buyers coming out there and people in suits that are looking at developing or investing. And you're seeing that in that particular market in South Carolina and northern Georgia. And I think you're seeing it in Colorado as well, where Dan does a lot of work to the south of Colorado Springs. And we're both very interested in going east and northeast of Colorado Springs because same thing, we were having a conversation with coffee and a guy said, man, Colorado Springs is getting too busy. And his attorney is moving out east because he wants land and he's tired of the traffic. And so you start hearing those types of things. It could be a good indication where you can purchase land at a discount and potentially have minor subdivision opportunity or just simple land flip opportunity because of the supply restriction in a different market that's affecting this new market.
Yeah, absolutely. A lot of good points made there, Mason. I'm very familiar with Charleston, that whole area. My parents live down there. I go down there quite a bit. And it is a frenzy in Charleston, and it's just spreading out like crazy in all directions, and especially between the major metros. When I think about the path of progress, I think about the major highways from one city to the next. And so Beaufort County is right along that path. So you made a lot of good points there. And also interesting where how to think about weighing the qualitative metrics, like that conversation you just heard, versus the quantitative. And everywhere that I've had the most success and made the most money, there were qualitative measures that felt like, okay, this is something that I followed. And giving anyone advice on how to measure that, I can't do. So sorry, guys, but trust your gut, I guess. But no, a lot of good points made there. As metros blow up, right, the second and tertiary markets will slowly do the same. And where I'm building those duplexes and that sort of thing, it's an example of that. So one distinction, too, and then I'll pass it back to you real quick, Mason. I think it's really important to talk about the difference between investing versus just short-term arbitrage to make money, where the places right now that I'm making money just in the short term with simple land flips, simple improvements and resales, that sort of thing, I wouldn't buy and hold because they're commoditized. There's very little restriction to build. It's very cheap. There's just low barrier to entry, and there's endless lots, all buildable, available, right? So the places where I'm making money with the land business versus the places that I'm buying and holding are very different. Mason's building in Pagosa Springs is a prime example of extreme difficulty, right? To bring on new inventory. You're between 14,000 foot peaks, right? It's very hard to build. That's a great example. So important distinction. But Mason, let me pass it back to you before I go on any further.
Yeah, and I think that's one of the challenges, which is why, from a business standpoint, I think long term in general, our investing strategy won't change very much. Of buy or build newer assets in markets where there's a relative amount of inventory constriction, but the permitting and building process isn't so impossible and difficult that you can never get anything done, and hold it for as long as you possibly can. Invest in companies that are never going to go anywhere. I think on the flipping side of things, which is more similar to gambling or the stock trading market, obviously we try to not have too much variation in the business that we're doing. If we try to do it in desirable areas where there's comparable sales, that we know that if we purchase something at a discount, we'll be able to sell it at more, do some level of improvement and make profit on the deal. But just like Dan said, I don't know if I would necessarily want to build and hold in these markets because they might be really, really hot for a while. And then as they cool down, you can see an appreciation of the asset and then a depreciation of the market value once more inventory. I mean, it's just simple in economics. And I think one of those things that we're always trying to figure out, which makes it seem like we're adapting in our business constantly or changing strategy constantly, it's kind of like the idea of Benjamin Graham, I think, in The Intelligent Investor, where once people start talking about it too much, it's too late. Because if you're in these markets where, Dan, you've been in some markets in the East and Southeast that might have, whenever you first got started, they were hot. Mm-hmm. And then they became so hot that everyone knows what their property is worth, so you're not going to be able to get a discount. So there is eventually going to be a top of the market, and who are we to decide? So you want to try and find it right whenever it's on the come up, because what ends up happening is all these failed developments that are out there, or failed markets where, like Hartselle, Colorado, or Crestone, Colorado, where these developers came in and split all these lots and never really came in and did anything else, and they sold them to all these people overseas or in the north or wherever, and those properties have gone significantly down in value, and they're probably not going to be worth anything for the next 100 years. Eventually, the path of progress will allow it to happen, but I know, Dan, just from a business and market strategy, you've gone into markets where there's been like a weird amount of correction where people have bought land for a ton of money, and but there's a new resurgence of demand in those markets, but the price has been corrected to a point where it's okay. Say they bought this land 25 years ago for $100,000, it's worth $40,000. So if I go in at $20,000, I can buy it and sell it and make good money. But
yeah, a lot to say there, but I'll try and keep it succinct. Yes, a lot of these North Carolina markets I'm in are substantially lower than what the lots sold for in the early 2000s, which is interesting. And Yeah, I don't think I need to beat the dead horse. I think you made a lot of good points there. And really one of the last points I wanted to talk about, or things I want to talk about just for everyone listening, market updates. As far as the day-to-day active business, just to make money, Florida has remained just unbelievable, where I like to focus on really competitive markets that everyone knows about because, number one, the competition's terrible. But number two, I mean, we are consistently selling these Florida lots within 24 to 72 hours of getting them on market. I mean, every single time. It's crazy. And a lot of these areas, prices have gone up and up and up. I mean, there's a market in Florida where a specific asset type, piece of land, the first deals I did there a little over 2 years ago, I was buying at 10, selling at 22, 23. And I was buying at 15, selling at 30. And then kind of maybe 25-ish, selling at 35 to 40. Well, now buy them at 30, sell them at 60. And they're going up even further. And it's the same lots in the same area. So all that to say, I have seen absolutely zero slowdown in the affordable Florida markets where there are huge amounts of new jobs, where new construction houses are still in the 2s and 3s, where people are flocking and money is flocking as well. And so that has not slowed down at all. How long that'll go on, I don't know, but I thought it's worth mentioning. So I'm tripling down on those. And I'm not investing in any of those markets because there are tens of thousands of lots with almost no barrier to supply. It's very easy to build. And I'm sure there's plenty of ways to intelligently invest there, whether it's picking specific neighborhoods or building specific product, or, of course, going coastal. If you're on the water, that's different. That's not commoditized. But that's not my market. I don't know it that well. I know it for simply buying and selling and making money. And so I'm going to leave it that way. So I'll pause there.
Yeah, and I think what's interesting about it is you've seen, in the long term, you've seen these markets essentially like go up overnight.
Yeah.
You saw that happen in Pueblo West, where the value of the land like tripled overnight essentially. And in certain areas that's going to happen, and it's really, really hard to keep track of all of that data, especially at a nationwide level, where sometimes all it takes is, okay, the city finished the water line and started providing water to this community, where a month ago we saw lots trading at 20,000, and now, what the heck, a recent comp just went and sold for 55,000. What just happened? And you'll see, the Tucson Water District announced that it's going to start servicing this particular area. So there's so much that you can do if you're in, to make this actionable for those that are interested in this space. Of if you're in the tech world and you can scrape the internet for city council meeting minutes. I don't know if this is illegal, so don't take my advice or anything like that, but see what the city council is doing. See what's going on in these local newspapers of where is development increasing? Where are the developers adding the infrastructure necessary, where there's so many pieces of land out there that people have owned for decades, if not 100 years, that all of a sudden could be worth a ton of money. And so if you keep up to date with it, these markets that are, for us, potentially just randomly, it seems, increasing in value by double to triple overnight, even though we've been doing business out there and we see the increase in demand. Some big city changes or county changes or state changes can allow land to significantly increase in value. So I think that in general, that's a majority of kind of the markets that we wanted to speak about on the land side of things, from the simple flip model, where there's some shortage of supply in one market, which causes another market that has a ton of supply to increase the demand, that then decreases the supply, that makes it really attractive for the short-term business model. On the long-term side of purchasing assets, where, take Dan's advice, buy stuff that's been built in the 90s or later in inventory restricted markets, where you know that it's going to continue to go up in value and it's going to add all this benefit to your net worth, and the depreciation benefit on the tax side of things kind of speaks to where we're at in our business, both short and long term. But I know we're continuing to work on a lot of exciting stuff right now.
Yeah, which takes us really to the last thing that Mason and I are focused on, which you've heard us talk about, but ground up partners. And it's been crazy, even in the last couple of weeks, where some of the deals that have been sent to us just further illustrate the point that this is such a blue ocean. Nobody can get capital, and there's a lot of people needing it because we're in a building boom. I didn't even get into talking about supply and demand and why I think U.S. real estate will keep going up. I think what I talked about is the biggest reason, but there's also the supply and demand issue. There's been a huge increase in population. And so all that to say, I'm excited. Our fund is almost launched here, which we'll give details on soon. But Mason, anything you want to say on that?
No, I think it just further illustrates the point that we try to make in business, where we see opportunity and we jump on it whenever we can. We're small business owners. We're not at the institutional level, and there's so many opportunities here, whether it's the institutional level developer or the institutional finance people. And there's all these gaps in the market, whether it's a supply issue of capital or a supply issue of land. These huge people in this space need help, and people like us need help, which is where Ground Up Partners really came into being. We were tired of the frustrations with getting money and raising money for deals, so we're starting a fund, which we will be very, very excited to announce and share all the details as soon as it's live with you guys, of really what it took to get it up, get it going, and the opportunities for both passive investors that want to diversify their investment strategy and make a great return, and for the business owners and operators like us that need access to capital at a reasonable rate and experts in the deal. So business is exciting. The market is still producing despite what the news and media is saying, and we're here to hopefully help you guys along with that journey.
Yeah, I think that's a succinct way to wrap things up, Mason. So that's it for today, guys. Go out there and close some deals. Mason McDonald and Dan Haberkost, Big Picture Blueprint, signing off.